Hey guys, how you been doing? I hope 2021 has been treating you well and that you're healthy and you're smiling and you're doing the best that you can to make it work. So, I'm going to be talking about a rather mysterious topic today. I find it is a bit of a black sheep of the investment vehicle family. It's called segregated funds. But full disclosure, before I start the video, I'm a licensed advisor. I sell this type of products to my clients and I talk about this on a daily basis essentially. I don't want any conflict of interest or saying that I am biased towards this type of product. Since you've made it to part 3 of my investment fund series, I would really appreciate it if you'd go down there and hit that subscribe button and smash that like button. It's calling for your name. Can you hear it? Okay, well, without further ado, let's get started. Welcome back to another episode of Money Talk with Hermy. My name is Herman. I am your show host. Everybody here calls me Hermy. You can call me whatever you want. You can call me Beanstalk if you wanted to. I've been called that. I've been called worse things, okay? So, today's topic is about segregated funds. Segregated funds are the insurance industry's spin on what an investment fund is. So it's very similar to what a mutual fund is, and in some aspects quite similar to what an ETF is. By the way, if you haven't watched my latest video on mutual funds, please click up here to watch it. Subsequently, if you haven't watched part 1 of the investment fund series, please also click up here to watch the ETF video. Alright, back at it. As I said earlier, the segregated funds are a spin on what a mutual fund and what an ETF is. But it's for the insurance industry. So what does that tell me automatically? Since insurance companies are inherently very conservative, these types of funds are not very high risk. More on that a bit later. The assets inside a segregated fund is separate from the assets of the insurance company, hence the name segregated funds. So a segregated fund, when it comes down to it, is an insurance product. Because segregated funds are an insurance product, there are always going to be certain guarantees to cushion the fall. And one of these guarantees is called a maturity guarantee. What that means is that the insurance company will guarantee 75% as a base minimum, and it can go up to 100% of your principal that you've invested in the investment fund. So, for instance, I invested $10,000 in the segregated fund today. The insurance company might tell me, okay, 10 years from now is when you will hit your maturity date, and that we will guarantee you 75% of your initial investment in case of a market downturn. So continuing on that scenario, on that 10th year, my funds are fully mature and I'm allowed to use that 75%, the market drops. So my initial investment now below 75% mark. Now say it's at $5,000. And then for some reason, I just decided, you know what, I'm out. I don't want to play in the market anymore. I don't want to invest anymore. I want out. So if I cash out at $5,000, if you're with any other institution out there that is not a segregated fund, you will not have this type of guarantee. The insurance company will be like, okay, you can cash out at $5,000, and then we will top you up $2,500 because I am guaranteed 75% of my initial principal. How likely is this scenario going to happen if you've already invested for 10 years? Very unlikely. And how likely is it that your investments will be at $5,000? Again, very unlikely. In that time frame, if your investments have done well, it is likely going to be much higher than $10,000. The second portion of the guarantees is called a death guarantee. This does not have a fixed date because we never know when we're gonna die, but it works very similarly to how the maturity date guarantee works. So using the previous example, I've invested $10,000 in this segregated fund with a 100% death guarantee, meaning now that the insurance company guarantees me 100% of the initial principal I've invested in. Then, say 5 years in, I got into a car accident and I unfortunately passed away. But the market had a massive downturn. My initial investment is now only worth $5,000. So half of what it originally was worth. So my beneficiary, if you were in a regular investment fund, would only receive $5,000. But because this is in a segregated fund with a 100% death guarantee, the insurance company now has to top up back to 100%. So they would have to top up $5,000 back to its original investment of $10,000 to the beneficiary. Now, how likely is this going to happen? Unlikely, but not impossible, because we don't know when market downturns will happen, just as you've seen in the last year, how many swings there has been. Let's not even talk about the March sell-off last year. Let's just look at the last couple weeks. It's been a bloodbath. So, these things happen, and unfortunately, we cannot predict when we're gonna die. Is it gonna come in handy? Probably. So what kind of investments can you hold inside a segregated fund? You can actually hold basically anything inside a segregated fund. It's very similar to how mutual funds and ETFs work. There'll be individual stocks, fixed income stuff like bonds or real estate assets, basically literally anything. There could be different themes. There are green investing segregated funds. If you want technology focused, there are technology segregated funds. Like I said earlier, it's just a spin of a mutual fund and an ETF, but it's specifically for the insurance industry. So we're not investing in anything scary, it's just done by a different industry. Another feature of a segregated fund is that you are allowed to designate a beneficiary. Wait, hold up. We can designate beneficiaries for all registered accounts. So what makes this so special? Because this is an insurance product, even non-registered accounts are allowed to designate a beneficiary. Give me 1 second, I need a cup of tea. You try going to the bank, you have some investments there or your savings account or whatever, and you want to designate a beneficiary, they say that's not allowed. So this is a special feature that is only allowed for segregated fund because it is an insurance product. Kind of piggybacking on the beneficiary designation, it is also creditor protected. So what that means is if you owe money or you go bankrupt or if something were to happen, creditors, people that you owe money to, can technically go after your assets in order to recoup their losses. If you have designated the beneficiary properly, as in what we call 1 up, 2 down, above you, you have your parents, next to you, you have your spouse, below you, you have your children or your grandchildren. If your designation of the beneficiary is any one of these people, you are creditor protected, meaning that now your assets inside your segregated fund is creditor proof. Your creditors cannot go after your assets because the assets in the funds are meant to be for the beneficiary. Of course, you making a contribution or investing inside a segregated fund needs to be made in good faith. Meaning that if you know that you are in debt and that you are going to go bankrupt, you're not going to suddenly start investing all your assets in a segregated fund and designating your husband or your wife or whoever as your designated beneficiary. Because then that would just prove to the judge or whoever is going after your assets that you did it just so to protect your asset. Segregated funds have the ability to bypass probate. This is the process to certify the will. This is a topic for another day because it can get very, very complicated. Basically, probate is the administration of the deceased's account. When someone passes away, all their assets get collected under one account, which then we call that is the estate account. And there are fees, of course, that you have to pay. Lawyers, accountants, and whoever that you need to pay. Paying the taxes to CRA, yes, the tax man will come after you even after you die. Probate is the umbrella term for all that other fun stuff that happens in there. Transparency is something that I push for in the work that I do. Remember what I said earlier in the beginning of the video, that there isn't much information out there on the web, and usually the information you find is quite biased, or maybe the person who is talking about it is not exactly educated in this field. Another thing that I want to mention is that the management expense ratio, and you might have heard me say MER before, this is the investment fund's fees when it comes to administering and managing the fund, is quite expensive. Okay, well, what is expensive? I'm talking like 2 to 3%. For the people out there who are a bit more fee sensitive, you might immediately be turned off by this product. As I said earlier, there's so many features. It's like you going to the frozen yogurt stand. The more toppings you take, the more expensive it becomes for your ice cream. Because there's so many features inside a segregated fund, and it can work in many different ways, that's why it's so expensive. Another thing I wanted to say is that there are thousands of segregated funds even offered just by one company. I work with a few different companies, and each of them have quite a few different selections of segregated funds. It's like you going to the bank and asking for a mutual fund. They have thousands of mutual funds. Does that mean all of them do well? No, they don't. If you get a good advisor, like me basically, then you're in luck. They will help you choose the right fund, and it could help you meet your goals. There's no such thing as a perfect financial product out there. Segregated funds are great. And for me, I'm a bit of an investment hobbyist. I love financial literacy, and I'm a bit of a nerd when it comes to that, as you can tell by my giant glasses. I think segregated funds has a place in every person's portfolio. There's always pros and cons to everything. There's pros and cons to investing in ETFs, as well as in mutual funds, and apparently in segregated funds. So that's it, guys. That was my pretty quick primer on what a segregated fund is. If you've never heard of a segregated fund, I hope I really did expose you to something new. As with anything that's related to finance, it's always best to keep an open mind, because you just really never know what type of product out there will work best for you, especially if you have a particular and special situation. Everyone's situation is different. An ETF might work for one person, but an ETF might not work for you. If I brought value in your life, please go down there and hit the subscribe button. Hello? Is that the like button calling? The like button is telling you to go down there and give that a quick jab. And if you have any questions about segregated funds, please leave me a little comment down below. Or if you feel like it, my email is in the description box. As always, stay safe, stay healthy. I'll see you guys next time on another episode of Money Talk with Hermy. Bye bye. And sometimes it can go higher.
Expensive is used as an adjective to mean costing a lot of money, similarly to costly and dear.
Okay, Google,
Do you want
stop.
to hear?
Okay, where was I?